The US is importing less oil as the country's domestic production increases, particularly from shale formations. In turn, many industry participants are pushing to loosen the country's 4-decade ban on crude oil exports. Joining me today to discuss this is Jason Bordoff, Director for the Center on Global Energy Policy at Columbia University in New York and former oil advisor to the Obama administration. Thanks for joining me here today.
Thank you for having me.
Companies can export refined fuels such as gasoline and diesel, but not oil itself except in special circumstances. Why has this been such a political hot potato?
Well, the oil export ban, the crude oil export ban in the U.S. is a legacy, a 4-decade-old policy that stems not even from scarcity concerns after the Arab oil embargo, but really from a time in the U.S. when we had price controls on oil, and price controls only work if you can't sell your oil into the global market and fetch the world price. This policy has stayed in place for about 4 decades and never really been much of an issue until recently, when we've seen, as you can see on this slide, a dramatic increase in U.S. oil production over the last 3 years, and all of that growth has come in the form of light, tight oil, and our refineries are better suited to heavier oils. So now this has become an issue because producers want to access the global market to export light oil so they can potentially sell it for a higher price. And politically, it's hard to overestimate the amount of sensitivity there is around anything that can be perceived as impacting gasoline prices.
But surely the US can afford to export more crude oil because it's producing just so much more.
It's producing a huge amount more. Oil imports have dropped dramatically. It is important for people to remember, we still are importing oil, and even under the most aggressive production growth scenarios for U.S. oil, we are still most likely going to remain a net oil importer. So this is not, like with natural gas, a situation where we have extra oil to supply to the global market or we're producing more than we consume. It's an issue of oil quality. We're producing a certain kind of oil, very light oil, that are change the economics of running our refineries. And our refineries just spent 2 decades and tens of billions of dollars developing the most sophisticated refining capacity in the world to process heavy crude from places like Mexico and Venezuela. And so the issue is, are we going to use that refining capacity in the most efficient way, or are we going to sort of force these refineries to take more light oil, which might discount the U.S. price?
So this is just a tussle between the refiners and the producers?
Well, right now, the concern is that the U.S. oil price might get discounted relative to the world price, Brent. And you can see over the last 2 years, the U.S. crude benchmark, West Texas Intermediate, has been anywhere from $15 to $20 below the world benchmark because of pipeline infrastructure bottlenecks in the U.S. mid-continent. But the Gulf Coast oil price, LLS, will roughly track the world price. For the first time at the end of 2013, as you see here, both LLS and WTI discounted and sold at a discount relative to the world price. And I think that sent a signal to some producers that they were concerned over time that even if we can move oil to the Gulf Coast, if that is a lot of light oil, we might face a glut of light oil on the Gulf Coast, have difficulty sending it to refineries, and they would fetch less per barrel, which is why they want to see the oil export restriction removed. And refiners like getting a discount, so that's why they're opposed to changing the policy.
But this ban is not going to be lifted in one fell swoop. We've already seen some movements on condensate exports, but also re-exports from Canada. There seem to be sort of various pressure release valves that can be used. To what extent will the administration do this, and over what period of time?
Yeah, there are 2 sorts of pressure release valves. The first are just how the market can respond. And if you look at this chart here, you'll see that we have already backed out light oil imports to the U.S. So as we produce more light oil, we stop importing light oil, largely from West Africa. We have dramatically increased the amount of oil that the market is sending to Canada because exports to Canada are allowed under current law. You've seen some blending that refiners have done of light oil with heavier oil to produce something more like a Saudi medium. So the market can take those steps, and then the question is, will policy respond? The administration can take a number of steps. First, Congress could change the law. That seems unlikely. Within the existing regulations, there's some ambiguity and flexibility over allowing, for example, swaps with Mexico, over how you treat condensate, which is very light oil, and some recent rulings from the Commerce Department hinted in that direction. And then eventually the president has the authority to find it's in the national interest to create a whole new category of exports, and that is something that could be done too, but I think that's a heavier lift politically and probably further down the road.
So what's the impact of all of this on prices?
Well, prices for consumers at the gasoline pump probably should not be affected. There's no restriction on exporting gasoline from the U.S. Those prices are set in the global market. So when there's a discount for the U.S. oil price, refiners benefit, but consumers pay the world price. If anything, encouraging a little bit more production through higher prices might put some downward pressure on gasoline pump prices.
Thanks, Jason.
Thank you.